The U.S. Securities and Exchange Commission formally proposed new rules allowing entrepreneurs to raise money through crowdfunding. For the first time, unaccredited investors have been given the opportunity to buy stock in companies using a crowdfunding exchange, allowing companies to avoid the traditional costs of going public. Before, business owners would have to go to the large financial institutions and venture capital firms that decide which companies get financing and which don't based on estimated success. Now they'll be able to go directly to people who believe in the company's idea or product. The rules are a direct response to Title III of the Jobs Act passed last year. It opened the door for small businesses and promising companies to access a wider pool of investors online. Crowdfunding sites have been doing this for years, allowing interneters everywhere to invest in specific projects that interest them. Some sites provide incentives for participants, others allow project creators to give prizes for certain tiers of investment. This is more like buying part of a company, and there wouldn't be free shirts, not that we know of anyway. The rules paved the way for a funding portal, a website electronically connecting investors with young companies looking to raise money. Solicitation has been illegal since the 1930s to protect investors. And before that decision was made, state regulators were wary that separate rules for crowdfunding could create a, quote, casino with more losers than winners. But crowdfunding will undergo SEC oversight, requiring all funding portals to register. Here are the other rules. Companies who opt for crowdfunding can only raise up to $1 million in a 12-month period of time. Investors would only be allowed to invest up to $2,000 or 5% of their annual income or net worth, whichever is higher, if their net or annual incomes are less than $100,000. Investors with incomes greater than $100,000 would be able to invest 10% of their net or annual incomes. The cap on investors would also take place over a 12-month period. Securities bought through portals would have to be held for a year before they can be sold. But before you start funneling your money into startups hoping to find the next Twitter, Facebook, or Instagram, know that there are very big risks involved.
There's 2 of those minted a year.
That's Naval Ravikant, co-founder of AngelList. It already does crowdfunding with high net worth investors.
If you have 50 investments and 2 of them turn out to be big hits, you're done way above average.
Despite the vote, equity crowdfunding won't be a reality for the next 90 days. It is currently up for public comment, which will be reviewed by the SEC before a final decision is made. For Newsy, I'm Christian Bryant, multiple sources, a broader view.